Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have an extra special guest. Heather Brilliant is CEO of Diamond Hill. They are a publicly traded investment manager, stock symbol DHIL, that have been public since day one, since 2016. Heather comes with a fascinating background, having previously been in a number of other places, most notably Morningstar, and she has a very specific approach to investment management and thinking about stock selection. They do a number of things at Diamond Hill that many other investment shops don't. Not only are they very much aligned with their investors, they regularly close funds when they get too large, when they reach capacity, and run the risk of reducing performance. All of their portfolio managers not only are substantial investors in each of their funds, but they do a disclosure each year that shows each manager by name and how much money they have invested in their own fund. Kind of unique. I wish more mutual funds and ETFs showed that data. I found our conversation about her work and Diamond Hill to be absolutely fascinating. They have a very unique approach. I think you'll find it fascinating. Also, with no further ado, my discussion with Diamond Hill CEO, Heather Brilliant. Heather Brilliant, welcome to Bloomberg.
Thanks for having me, Barry.
Well, thanks for coming in. So let's start with your background. A bachelor's in economics from Northwestern and then an MBA from University of Chicago. It sounds like the career plan was always finance. Was that the plan?
It was not the plan. I actually wanted to be a lawyer. And so I started out as a political science major. And that really came from my experience on the debate team in high school and college. It was a big part of what influenced me. And I realized after undergrad, actually, that the skills you learn in debate can really be applied to picking stocks, where you really have to understand both sides of the story, but you still have to come down on one side and make a decision. And so I felt like all of those experiences just really led me to love investing.
Really interesting. So what was your first job out of undergraduate?
I worked at Bank of America, and they had a wonderful corporate finance training program. So since this was a relatively late decision that I came to, it was great to have those kind of 6 to 8 weeks of training before they set us loose.
And what led to the decision to get an MBA at Chicago?
Well, actually, I had pursued the CFA program first, and I learned about the CFA from a colleague at Bank of America, and I got right on it. As soon as I learned about it, I thought, this is great, and wished I'd even known about it sooner. And then I had a role at one point where they told me to advance to the next level, I needed an MBA. And it was an investing role. So I said, why would I need that? I have a CFA. And they said, sorry, rules are rules. And I never wanted to be told that again. So I thought, I'll just get an MBA too.
And how did you find University of Chicago? There are some legendary professors there, Eugene Fama, Dick Thaler, just really an incredible lineup.
There really are, and it was a very rigorous program, and I learned so much from classes that I never thought I would find exciting, like marketing. You'd think that marketing is pretty straightforward, but it turns out, the University of Chicago figures out how to put a quantitative lens on pretty much everything, and putting a quantitative lens on marketing back then, 20-something years ago, was pretty innovative, and I just thought it was really a neat way to learn about it.
Right, the old joke, half of our advertising dollars are wasted, we just don't know which. Once you start doing things online, that kind of changes. You really can track that, can't you?
Exactly.
So you've held analyst roles at a number of asset managers. You mentioned Bank of A. You were at Dry House Capital, Cog Hill Capital, Morningstar. Tell us what you learned at such varied institutions.
I really learned how to appreciate investment philosophies and figure out what my own personal investment philosophy was. My first equity research job was at Driehaus, and they're very aggressive growth, momentum-oriented. But I was on the international team, and so the guy who was running the team at the time had a pretty fundamental approach, really looking for more earnings momentum as opposed to price momentum. And I just realized how he always veered towards higher quality companies. And so I kind of leveraged that when I went to Morningstar because they're very focused on quality, the whole concept of economic moats, but also about buying companies when they're trading at a discount to intrinsic value. And it just seemed so much smarter to me to figure out ways to make sure that you're putting the risk reward in your favor.
And you were at Morningstar for about 14 years. Tell us what brought you there. What sort of work were you doing?
So originally I went there because I liked their equity research philosophy. And most people don't even know they do equity research, even to this day. But
I mean, you think Morningstar, you immediately think of the mutual fund star system.
Yeah, absolutely. But they had a whole team that was growing at the time because of the whole Spitzer settlement. And so they were hiring lots of people to come in and be equity analysts. And so it was just a great opportunity to get to apply a more fundamental investment philosophy. And from there, I really realized that while I loved being an investor or making investment recommendations, I also felt like it wasn't perhaps my true genius and that I might be more successful in the long run to focus on a leadership direction of my career. And so it was, I was actually only 30 when I got the opportunity to run the equity research team at Morningstar. So it was just a really great kind of early career opportunity to try out managing at scale.
Very interesting. I specifically recall what I thought at the time was a very bold and brave research report that Morningstar put out looking at the history of their star rating system. And they pointed out if you only could know one thing about a mutual fund, if you knew nothing but the cost, that would generate a little bit of positive return versus following any other system. And I give them a lot of credit for saying, yeah, we built our business on the star system, but hey, in a pinch, just look at what the expense ratios are.
It is fascinating how big a discrepancy that creates because, the expense is a sure thing and the expected future returns are very uncertain. And so I think you have to take expense into consideration.
So you become CEO of Morningstar. Am I pronouncing this right? Is it Australia or Australasia?
It was Australasia, but it's important to know that Australasia really means Australia, New Zealand, and the Pacific Islands.
Oh, okay.
It doesn't actually mean all of
Gotcha.
Asia.
I got it. So did you have to relocate? Were you working there?
I did, yes. My family and I moved to Sydney, Australia.
And what was that like? Sydney looks like it's a blast.
I consider Sydney one of the most majestically beautiful cities in the world. It was so wonderful. Every day we lived there, I felt lucky.
And livable, right? It's not like Hong Kong or New York or some other cities that can be a little much to take if you're not from there.
It's very livable from like a human interaction standpoint, yes, but it is very expensive. Mm-hmm. So I do think a lot of people struggle, especially, when you see some cities that have suffered with very high housing costs. Sydney is definitely right up there.
Sure. So you're at Morningstar for a while. You leave for a year and come back. Tell us what brought you back to Morningstar.
I left because I thought I was being offered my dream job. And so I went to a hedge fund for a year. I learned so much in that year. I'll never regret doing it. And it was the only time in my career where I've had responsibilities for recommending shorts as well as longs. Mm-hmm. So I think it was very eye-opening from a lot of perspectives. But ultimately, I just really felt like the intensity of the role and expectations was not going to be tenable. And I was at the point in my life where I was ready to have a family. And so it just made more sense to stick with the philosophy I believed in, but do it in an environment that I felt like could give me a little bit more opportunity to have balance.
And then post Morningstar, you end up in the late 2010s as CEO of First State Investments for the Americas. Tell us a little bit about that role and what you learned being CEO there.
Yeah, so I love my time in Australia, and we were there almost 4 years. And at the end of that time, I really felt like as much as I had learned and experienced at Morningstar, it was time to move on. And so I had a lot of contacts in Australia at that point, and one of them was the CEO of what was at the time called Colonial First State Global Asset Management. Mm-hmm. And so First State Investments was the non-Australia part of that business. And so they hired me to basically move to New York and run their business in the Americas. And in the process of doing that, the business, which had been owned by the Commonwealth Bank of Australia, ended up being sold to Mitsubishi UFJ. Mm-hmm. And so it was a really interesting time to kind of see through that whole process. And it's called First Sentier now. The business does still exist. But it was a really interesting couple of years.
And if I recall correctly, Mitsubishi Bank during the financial crisis was a financer of a couple of pretty substantial U.S. banks, maybe Morgan Stanley. I don't remember. Is that right? And so tell us a little bit about what your experience was like. You were there before Mitsubishi bought them, correct?
My last day was the day the acquisition closed.
Oh, so you helped facilitate this? What was your role in that acquisition?
I mean, the deal was definitely done in Japan and Australia, not in the U.S.
Right.
So I certainly had a lot of interaction with the team from Mitsubishi that was based in New York, and kind of helping facilitate some of the transition that would be happening. But I had already taken the role with Diamond Hill, and so I helped them, for a little bit of time to kind of navigate through the final aspects of the transition.
And I don't recall if this was on the podcast with John Mack or in John Mack's book, but he had nothing but really nice things to say about Mitsubishi. I mean, they helped save Morgan Stanley. He was certainly appreciative of that, but he seemed to think that there were no nonsense. They looked at the data. They made a fast decision one way or another. He was pretty pleased with them. I'm assuming you had a similar experience?
Yeah, and I'd say one thing that's so great, and just to overgeneralize about Japanese bank owners, is that they tend to be very long-term oriented. Mm-hmm. And so they're making decisions about investing for the future and not just about, making quarterly earnings or any kind of short-term pressure.
So we'll talk about long-term investing in a bit. Tell us what brought you from First State Investments to Diamond Hill.
Given some of the transitions with First State, I knew it was time to maybe consider the next opportunity. And so I had actually interviewed for a couple of things when I got a call from a recruiter about Diamond Hill. I had actually never been to Columbus, Ohio before I went there to interview. And so when the recruiter called me, I said, it sounds really interesting. I feel like the investment philosophy alignment is great, but I've never been to Columbus, so no. And so he said, well, wait, they're coming to New York for the first round of interviews. I think you should just take the meeting. What's the downside? And so I was actually a little skeptical, but the more I researched the company, the more compelled I was. Not only is the investment philosophy very aligned with the way I think about investing, but the team is incredible. And even from my first trip to Columbus, I realized what an amazing, livable city it is. And it's a growing city, which is, something not a lot of cities in the U.S. can claim today. And so, it ended up being, I think, a really good fit.
So since you mentioned investing for the long run amongst the Japanese banks, on the Diamond Hill firm website, your tagline is invested in the long run. Shouldn't that be the norm in asset management? Aren't we all supposed to be invested in the long run?
I think it absolutely should be the norm because it is generally what our clients are seeking. And I think there's just so many pressures that cause so many investors to think shorter term. And even investors who claim to be long term are often thinking in 1 year increments as opposed to the more like 5 year increments that we're really trying to think about.
So is that the fault of the end investor? Is it the institutions that really look at quarterly results? I know some hedge funds look at monthly or weekly results. That seems to be, nothing more than random noise, but they seem to focus on it. Who should we be blaming about this sort of short-termism that can be endemic in the investing world?
I don't know if we can really blame any one party. I think it's kind of systemic at this point, where you have companies reporting earnings on a quarterly basis. So many public companies expected to issue guidance and then meet that guidance or else, essentially. And I think a lot of investors have figured out how to effectively make money for their clients with shorter term time horizons. Otherwise, they wouldn't be doing it. And so I think there's enough forces out there that lead to people thinking that they can make money doing it. But I think there's more opportunity to take a longer time horizon or a longer term perspective, because then you can really think about, what are the earnings power, what is the long-term earnings power of this business, and how can I think about myself as an owner of it in partnership with the management team, as opposed to thinking about kind of where the stock price is going.
So we kind of joke about the illiquidity premium, but really we should be talking about the long-term premium that's being overlooked. Maybe there's a substantial market inefficiency there.
I think there is because, while I do think that clients like to invest for longer time periods, they only have so much patience. And when you take a really long time horizon, you can have multi-year periods of underperformance. And so that's not something that every client is willing to tolerate. And it's also very hard, I think, for all the parties involved to be able to consistently know, is this underperformance because my investment manager is sticking to their philosophy, or is it a deeper issue and I should be running for the hills? And so I think it's really, really important to have a consistent philosophy and be able to show over, as much time as possible, ideally decades or more, that your ability to focus on a long time horizon really does come back around and generate outperformance for your clients in the long term.
Really, really interesting. So let's talk a little bit about Diamond Hill, stock symbol DHIL. What's it like running a public company? They've been public since 1996.
So yes, it has been a public company really since the founding, because essentially there was an already public business that the founder of Diamond Hill kind of merged into or used as the beginning of Diamond Hill. So there was never a moment where the company went public. It's really just been a factoid of the whole history of the company.
It's been public from day one.
Yes.
So earlier we were talking about investing for the long haul. What sort of challenges are there when shareholders are looking for quarterly results? They're looking for revenues and improvements in profits. How do you get people to focus on the long term when every 3 months there's a snapshot of here's where we are in the cycle?
There's nothing we can do to avoid the fact that we need to publish our results every quarter, but there are actually things that a lot of public companies do that are not a requirement. For example, quarterly earnings calls and guidance. And so those are things that we don't participate in because...
No guidance, no quarterly call.
Correct.
Just you release the numbers and let the chips fall where they may.
Exactly. And the reason why that's so important is because we don't want to, on a quarterly basis, be essentially pressured into focus on a shorter time period by people asking questions about a shorter time period. And we do think that the short time periods are noise. And so what we do instead is we hold a shareholder meeting or a management presentation for shareholders once a year, where we do, kind of take a step back and look at the year in review, our expectations going forward, and really try to lay out, the strategy and how we are evolving in this ever-changing market.
Diamond Hill has always been public from day one. The founder sort of reverse merged the company into an existing public entity. Does that mean the float isn't giant? That a lot of the holdings are held by founders? How much of the stock publicly trades?
It's actually pretty big. It's about 80%. So it is just under 20% owned by management and directors. I think actually if you go public, there tends to be more of a concentration in owners holding
founder stock.
Exactly. But when the situation is more like using stock to fund the beginning years of the company, I think it ends up leading to a more diverse shareholder base.
And you mentioned founders and managers. What about employees? Do they have the opportunity to participate in an ESOP or anything like that?
We have a very strong commitment to an ownership mentality, and we think that owning a piece of the company is part of that. It's really just a small part of it in the grand scheme of things. It's more about thinking like an owner when we're making everyday decisions. But we do reinforce that by providing a grant of shares that vest in 5 years for every employee when they start. And then we have programs to, allow for employees to purchase shares at a discount and also to be able to participate for certain roles in a long-term incentive program.
You mentioned ownership mentality. As I was clicking around your website, I found a fascinating document that shows each of your portfolio managers by name, the funds they manage, and how much of their own dollars are invested in their own managed funds. And very often, these are 7 figures or more, millions of dollars invested in their own funds. Tell us a little bit about that.
I'm so glad you brought that up because I do think it's a really big differentiator for us. We have really focused on the fact that if we're invested alongside our clients, we're making decisions for them that will be in our best interest and their best interest. So we really think that it creates alignment to have our portfolio managers meaningfully owning shares of the funds that they manage. Now, of course, that is completely up to them. But when we're hiring people or promoting people, we really do make sure that it's clear that this is, something that we think is a differentiator for us. And I'd say part of it is reinforced by the fact that we do have policies that prohibit our employees from investing in individual securities because we want their time to be devoted to making the right decisions for our clients. And they can benefit from that as a client. And so I think that's really just led to a culture where we really all feel like we're there for the benefit of our clients.
What's a better advertisement for a mutual fund than the fund manager having millions and millions of dollars invested in that exact fund?
Absolutely.
So there's another line on your website that kind of caught my attention. Our curiosity uncovers unique opportunities. Tell us a little bit about that.
So on the equity side in particular, a lot of what we do really is to do very deep fundamental research on companies from a bottom-up perspective. And so we're constantly looking for new ideas and opportunities to put in the portfolios. But despite that constant curiosity, our portfolios do not have very high turnover because we are taking such a long-term perspective. So we're looking for businesses that are fundamentally mispriced relative to what we think, a normalized earnings environment would result in. And sometimes that's caused by dislocations for the business that we think will reverse. Sometimes it's, growth potential in the future that we don't think is priced in. But there's always got to be some element of the valuation really being compelling. And I think, if you're really looking at the intrinsic value of a company and estimating the cash flows the business can generate and looking for opportunities where the stocks are mispriced relative to that, you have to take a long-term perspective.
I'm hearing a couple of things and I want to ask some follow-up questions. So bottoms-up stock selection, pretty obvious. It's not that you're doing sector rotation or market timing. You are purchasing specific companies, but then the added layer is you're purchasing them at a discount to intrinsic value. So this sounds a lot like traditional value investing, which has had a rough couple of years. How do you differentiate yourself from, traditional value investors?
I think there's a lot of what we do that I would say is not too far from being traditional value investor. I'd say both for Diamond Hill as for a lot of investors, there's kind of an ideal out there where you want to buy a company that has a strong competitive advantage, trading at a discount to what you think those future cash flows are worth. That is kind of the fundamental perfect investment opportunity for almost any investment philosophy. Mm-hmm. And I think the difference between, a traditional value investor versus, we kind of call ourselves intrinsic value investors versus someone who calls themselves a growth investor is just really, what do you prioritize when you don't have that ideal situation? So for us, we'd still rather buy a higher quality business trading at a small discount than a low quality business trading at a big discount. But fundamentally, I'd say it really requires you to understand, what is the competitive position of this business and how predictable are those future cash flows.
When I hear competitive position, I immediately think of the Morningstar moat you described earlier. Tell us how that works into your investing philosophy.
It was interesting coming to Diamond Hill. I think one of the reasons why the portfolio managers were comfortable hiring me as, the first external CEO that they had ever had is because I had very widely talked about economic moats and investing with an eye on sustainable competitive advantage. But even in the book I wrote in 2014, you could see that the focus on competitive advantage can never be absolute. You always have to take valuation into consideration. I would say in general, we probably put a little bit more bias towards valuation as the primary consideration and competitive advantage as very important, but maybe second to valuation as a primary consideration.
So valuation, high quality, competitive advantage. Are we leaving out any other specifics that go into the investing stock selection process?
Very concentrated portfolios and a long-term perspective.
So I love when I hear concentrated portfolio because I immediately think high active share,
yes.
No closet indexing.
Exactly.
So when you say concentrated, how concentrated is concentrated?
So our large cap strategy has about 50 positions in it.
Mm-hmm. That's pretty concentrated.
Exactly. So I think that gives you an example. Small cap is more than that, but it's still less than 100.
Small cap is always more than large cap. We're going to talk a little bit about small cap later, which has been kind of fascinating what's been going on in that space, lagging for as long as it has. But before I get to that, I want to talk about not only how you express the philosophy in investments, but the different strategies you run in equity and fixed income. I know you do separately managed accounts, you do mutual funds, and you also do a CIT. Explain those choices.
So essentially, we try to offer our intellectual property to our clients in whatever vehicle that they need it to be in. We started out kind of focused on mutual funds as the vehicle, and we've really diversified away from that because of client interest. Clients have asked us for separate accounts, model delivery, CITs, and we have happily obliged. Now I'd say the big topic, on the table is ETFs. Mm-hmm. The challenge with ETFs is that you cannot constrain capacity. And we believe very strongly that in order to make sure that we can always deliver for our existing clients, we have to be able to close strategies. Or
to be able to say no and close a fund down, not just fire hose of capital coming in.
Exactly. And as many very popular ETFs show, and as just is fundamentally true, you cannot close an ETF today. And so in order to take capital in an ETF, we have to figure out some kind of solution to that. And we have not figured out a solution.
That's really interesting. So I know you're running about $29 billion total. How big is the biggest fund where you say, okay, we're pretty close to capacity here?
So our large cap strategy was closed to new investors until about a year ago. Mm-hmm. And so over the course of history, we've closed 4 strategies over time. And, generally, I'd say we take a lot of things into consideration. Our clients actually like to be able to put new clients of theirs into the same strategies. Mm-hmm. And so it can be very disruptive for client bases for you to just abruptly and suddenly close strategies. So it generally is something that we plan as we see it coming and really try to collaborate with our clients so that we can appreciate where it may create a challenge for no reason. But in general, we've closed. At times we've had small cap, SMID, and large cap.
SMID.
Yeah.
By the way, a little industry jargon. I always laugh when I say that. We lapse into jargon all the time. So small and mid cap.
Yes.
So I would imagine the large cap has bigger capacity, 8, 10, 12 billion. Where do you start to run into, hey, for 50 stocks, this is as big as we want to get?
Yeah. I mean, we think the capacity for that is somewhere around 25 or 30 billion.
Oh, so you haven't really run into issues with that yet?
Yeah. I mean, I would say that's for the strategy overall. So it partially depends on how much is in the fund versus in other, other areas. But
in a small cap or a SMID, you can say to your investing partners, hey, we're getting to the point where we're just about capacity constrained. Don't be surprised if this closes next quarter, next year. How far out do you plan it?
I mean, generally, if it's flows related, it's easier to plan. If it's market related, it's harder because, if all of a sudden small caps make a comeback, when you didn't think you were anywhere close to closing, it can come up more quickly. With large cap, I'd say it also depends on how low you go in terms of market cap, right? How small a company will you put into a strategy that is considered large cap? So for us, I'd say that is a big swing factor that constantly gets debated. And what we always try to do is look at the actual history. Where have we actually invested clients' capital? Because that is what has created our track record, and that we need that in order for it to be, repeatable in the future.
That's really interesting. So what do you use as a benchmark for the large cap fund? Is it just the S&P 500 or something a little broader?
We use the Russell 1000.
Mm-hmm. So much broader.
Yeah.
I was going to say, if you want to just arbitrarily draw a line in the sand, the top half of the S&P 500, I would imagine those 250 stocks can be considered large cap, or like what's the line in the sand? Above 10 billion, above 25 billion? It's hard to even judge when we have so many companies that are $1 trillion market caps these days.
Well, that actually brings up a really interesting point in time, I'd say, with our markets being so driven by such a small number of stocks. And we generally think that creates opportunity, not only in the large cap space, but really across the cap spectrum. But, even in the first half of 2024, more than 60% of the return came from 6 companies. Mm-hmm. And so I do think we're getting to the point where what you see going on under the surface is so different from what the overall, quote unquote, market return looks like these days.
I'm so glad you said that. Every time I have a discussion about passive or indexing with people who are convinced it's going to destroy the structure of the market, my answer is always, wouldn't that create more inefficiencies elsewhere in the market? If all these flows are blindly going into passive, and there's certainly a reason for that, but tell us about how that leads to inefficiencies that savvy investors can take advantage of.
Yeah, I think you can see this particularly in smaller cap companies right now, where, as you alluded to earlier, the Russell 2000 versus the Russell 1000 has basically underperformed by 95% from the end of 2016 until now.
That's amazing.
It's stunning. And, it's true that smaller cap companies are much more challenging because, 40-ish% of small cap companies don't make a profit.
Right,
and so
right.
I
think we're at 7% of large cap of the S&P 500 is not profitable, which is a fraction of what it was in like the late 90s.
Right.
Much more of the big caps weren't profitable. Today, they're all money machines. The small caps really are kind of struggling against that.
And the interesting thing is that small cap active managers have outperformed out of the last 4 years. But in small cap, about 60% of assets are invested passively. It's actually only 50% in large cap. So it's kind of surprising that investors are relying on passive strategies in a category where active management makes a huge difference.
So let me make sure I'm hearing that correctly. 60% of small cap is indexed versus 50% in large cap, and more small cap managers are beating their benchmark than large cap managers.
Yes.
Am I getting that right?
Exactly.
So that kind of goes back to, hey, the more indexing there is, the more opportunities there are for inefficiencies to be discovered.
Yes, but I would say that one element of reality I think that has for managers who are focused on smaller cap companies is that you can't buy an undervalued company in small cap necessarily and assume that it's going to appreciate because of valuation, because we don't know when or what will cause the market to re-rate small cap. And so, this has been going on for, basically a decade or more, depending on how you look at the data. So I think given that, what we see is our analysts and portfolio managers increasingly focusing on investing in small caps that are high quality businesses, generating cash flow, returning that cash flow to shareholders, where essentially the cash return is going to get you what you need as an investor, and you don't need the valuation to re-rate. If it does, it'll be bonus.
That's dividends and buybacks in terms of, David Einhorn said something very similar when people were saying the market structure was broken by passive, and I know he's in that camp. He said it made us rethink our approach to valuation, and if merely buying inexpensive stocks wasn't going to get you the performance you need, well, then you had to find the stocks that were doing something to raise their valuation themselves, mostly through return of capital to investors.
Yeah, that was a great episode. I think Einhorn had a lot of really good points that I think were
so
really valid.
you agree with him. It's, hey, we like these stocks that are actually participating, and there are opportunities being created by the rise of passive. So let me ask one other question about the rise of indexing. It has helped to contribute to fees coming down across the industry. You're a public company. How do you deal with those fee pressures that seem to be endemic throughout all of investing?
I mean, from the beginning, we really tried to take a very thoughtful approach to setting our fees. And, we really try to think about, what do we believe the excess return is that we can generate over the long run? And how can we, charge a fair price for that so that we can make sure we can pay the, investment talent that we need in order to generate those returns, but also make sure that the shareholders of the firm are getting, paid back for the capital they provide, and ultimately that the clients are getting a return after fees that makes sense for them. And so that kind of third mentality has led us to set fees at a place that, generally do not exceed the median of kind of Morningstar categories for fees. And we look at that too, because we really want to make sure that we are not charging more than we think is the value we can generate.
Fair enough. So we were talking earlier about small caps. They've been lagging not just since the pandemic, but pretty much the past decade. What do you think the reason for that is? Is it access to capital or international markets? What's been holding small caps back?
I actually think there's a couple things, but the biggest is that small caps have not done so poorly as much as large caps have just done so excellently. And so I think that's partially these 5 stocks really driving the market that we're really seeing come to a head this year, but really has been going on for the last several years. And we've seen concentration in the large cap side of the market among those 5 companies getting greater and greater over that time period. So it's just very hard for any kind of diversified portfolio to keep up with that. And you can see that in a diversified large cap portfolio, in any kind of actively managed large cap portfolio relative to indexes. And you can certainly see it in small caps as well.
Right. I have a friend who's a trader who says, hey, you can't eat relative performance. Right?
Exactly.
So we talked a little bit earlier about profitability. 93% of big caps are profitable, but only a little more than half of small cap stocks are profitable. How important are earnings to the small cap sector as a driver of returns?
I mean, I think quarterly earnings probably should be less of a driver for small caps because, you have to take a long-term perspective and really think about when they might become profitable. And I think also small caps tend to have more issues with debt. So it's really important for small cap investors to be very aware of the leverage that the companies are carrying. And I think in this environment, too, to really understand the interest rate that leverage carries and the potential interest rate that they may face when needing to refinance that debt.
And it seemed like the large cap and mega cap stocks did a great job in refinancing before the pandemic. Small caps did not have access to the same amounts of capital at the same prices. How big of a factor is that?
I think it's a huge factor. And, and you also see less leverage, certainly as a proportion of cash flows when you're looking at large caps versus small caps. So they're more levered and they did not have the same access to benefit from all that cheap capital when it was available.
Diamond Hill is known mostly as a stock shop, as an equity shop, bottoms-up stock selection, but you also do fixed income and bonds. Tell us a little bit about the fixed income side of the work.
Yeah, so about $4 billion of our assets under management are in fixed income strategies today. And that's really grown over the last couple of years because we brought in a team in 2016, have been building a track record since then, primarily in two strategies, core and short duration securitized. And in both of those strategies, I would say our biggest point of differentiation is our focus on securitized assets, which kind of gives us the opportunity to be able to make investments in areas that I think other bond managers either don't know as deeply or are more focused on macro trends, where we take a bottom-up approach there too. So it's really given us, I think, the opportunity to shine in markets where it's been harder and harder to outperform in fixed income. And so creating that long track record, then as we saw the environment change and the interest rate regime change, we've really been able to benefit from that and deliver for clients.
And when I think of securitized assets, we typically think of mortgages and things like that. What sort of securitized assets are you guys playing with?
Yeah, certainly mortgages is on the list. I'd also say asset-backed securities, which can include things like, credit card receivables or car loans or things like that I think are more consumer-oriented. And so that's an area where there's been a lot of concern about recession, ebbs and flows. You definitely see people's concern about asset-backed securities move in line with that.
Yeah, the recession concerns seem to have been a perennial miss since the last recession, since the COVID recession,
right,
which was a hot minute. And then all people were doing was expecting a recession in 21 and 22. And even during the downturn in the market in 22, this is it. This is what's going to finally cause a recession. And then a giant snapback in 23. I know you guys are bottoms-up stock pickers. How impactful is all that macro noise on your process?
I mean, I'd say it actually creates more opportunity than anything, because when the market starts really worrying about a recession, then it generally undervalues companies that are more cyclical and in terms of their long-term, cash flow generating abilities. And when the market's not at all worried about a recession, then you can generally find opportunities in more defensive areas of the market. And so we do try to kind of keep in mind where we think the economic outlook could be causing a different short-term perspective than a longer-term perspective.
So 2022 must have been a friend from the military always describes it as a target-rich environment. What were you guys doing in 2022 when the S&P was down about 20% and the NASDAQ was down about 30%?
Yeah, I mean, I think those are good examples, but I actually think the environment is better right now. Because
really?
Yes, because we're in a situation where while the market is up, double digits for this year, that's really a kind of high level perspective that really obscures what's going on under the surface, where there's a tremendous amount of volatility. We're seeing the performance of individual companies vary widely and is not at all representative of that high-level market return. And so it's kind of like the iceberg analogy, right? It looks tiny from the surface, but when you dig underneath, there's actually a lot more noise going on. And that really leads to a lot of idiosyncratic risk, which is what we look for. We want companies that are going to sell off when they miss their earnings or create opportunities because of short-term focus that can be overlooked for a long-term investor.
And we're recording this in July, so let's put some numbers out there. The first half of the year of 2024, S&P 500 up, I think, 15.3%. But the average stock in the S&P 500 was only up about 6% and change for the first half of the year. And I want to say the average stock in the second quarter in the S&P was slightly negative.
That's right.
Down 1.3%, something along those lines.
Yep.
So really, that seems to really show you what a wide dispersion we have in performance. How does that play into your bottoms-up stock picking?
I mean, I think it creates opportunity because we see companies getting sold off that are really great fundamental businesses, but, perhaps are going through a tough time or missed earnings for whatever reason. On the flip side, you see companies that, we really believe in and fundamentally in the long term that we may already own also selling off, or companies like the ones leading the market that have been doing so well. And the interesting thing, I think, about those top 5 companies is that they're actually very fundamentally strong. It's not like we're seeing companies that are so ridiculously overvalued. They are much more highly valued than the market on average, but that's partially driven by earnings revisions and people, realizing more and more how much cash flow those businesses can generate. I think what it's teeing up for is a future environment where anything that causes some instability for those extra large tech companies that are driving the market will really create a very different high-level environment for the market that will create opportunities for people who are really focused on bottom-up investing.
I'm glad you brought up that these aren't like just ephemeral ideas like we saw in the dot-com era. I think the numbers on the Magnificent Seven, collectively, they do about $2 trillion in revenue and about $300 billion in profits. Those are giant numbers. Kind of hard to argue there's a bubble amongst them. Hey, there's some speculation and there's a little bit of over-enthusiasm, but these are really very, very well-run, well-managed companies that have become money-printing machines.
Yes. I mean, I think that is true. There's still a valuation consideration to be applied. And I think you could argue that they're not meaningfully overvalued right now, but it really all comes down to the future growth expectations and their ability to keep on delivering like this. And so, if for whatever reason, regulation or some change in the environment caused that to slow down, then it's a lot harder to justify these valuations.
I was clicking around the website, looking at some of the white papers you guys put out on a regular basis. Let's talk about one or two of those. Uncovering opportunities in commercial real estate, the power of location. Let's talk about stepping into a dangerous area. I think for office space anyway, per square foot, nationally has fallen from about $350 to $199. Tell us a little bit about opportunities in commercial real estate.
I think commercial real estate, as our bond managers would say, is clearly an area where the baby gets thrown out with the bathwater. Mm-hmm. And so if you focus on super high quality opportunities, then I think you can really find, mispriced securities, essentially, because everybody is so worried about commercial real estate. And that worry is not without reason, to your point. It
particularly in office space, but
yes.
There's a lot more to commercial real estate than just office space.
Absolutely. But I think in, very high quality office, they're finding opportunities as well. Mm-hmm. And so it's partially, I think, a matter of looking for where investor expectations get so lumped together with the overall category, and the bottom-up perspective can show actually there are individual buildings or opportunities in commercial real estate that can provide opportunity.
What about geographies? Diamond Hill is located in the United States, but it seems that your experience has been all over Australia and Asia. Japan has had a great year. We're starting to see signs emerging market is doing better. Europe, the perennial laggard, even Europe is starting to show signs of coming alive. How do you look at the rest of the globe? What are your constraints?
So we have an international equity team that really focuses on looking for opportunities outside the U.S. And they travel the world, meeting with management teams and, really uncovering the depth that you can't get just by, staying in the U.S. at looking at the data. They do obviously spend a lot of time doing that. But I'd say that's really led to a focus on areas that are more bottom-up oriented. So, just like on the U.S. side, we're really looking for individual companies that lead to opportunity, but you do occasionally find areas of the globe where, you either want to avoid it wholeheartedly, even if there might be a company that looks interesting, or where there's a lot of undervalued businesses that we can invest in. And I do think that among technology, which is, a very international industry, very global industry, there are some opportunities there because when you look at names like TSMC and Samsung that are really fundamentally great businesses, even before AI caused things to go crazy, I think that's just an area where our team's finding a lot of opportunity.
What about strategic capacity management? How does that improve client outcomes?
So essentially, that kind of goes back to what we were talking about before, where it's really important to consider the capacity of strategies that we manage so that we can put our existing clients' interests first. And so when we look at how much we think we can manage in a strategy, we try to take into consideration what the investor experience will be. And if you're looking at small cap, for example, I think it's easy for people to understand this, where, we can clearly see that small cap managers that take on too many assets tend to have a much harder time outperforming the market over the long run. So if we just explicitly say we think we can manage about, $2.5 billion in small cap, and when we get to that point, then we're not going to take new clients because it's really important for us that the client experience is more important than our ability to generate more revenue by bringing on more assets.
And what about Longshort? You have a fund that runs Longshort. Tell us a little bit about that. What's the thinking? When I hear bottoms up stock picking, I no longer think about short selling, but obviously if you identify something that is mispriced to the downside, perhaps you can also identify things mispriced to the upside.
Yeah, that's basically the philosophical approach that we've taken. And I'd say there's a few people on our team, one of the portfolio managers on that strategy and a couple of analysts who have really developed expertise thinking about the short side. And so, but fundamentally, it really is about valuation. Now, it's harder, obviously, when you're trying to short an overvalued company than buying an undervalued one, because you can only wait so long if the stock's running against you. But we've just really developed an approach, I think, that takes a little bit more of a diversified approach on the short side and gives a little bit more room to situations that might not unfold as quickly as you hope.
Are these 130-30 funds or are they market neutral funds? How do you structure them?
They are essentially 60% net long. So that's been our focus historically and really what our clients have asked of us. But it is an area that I think could be ripe for innovation because it is easier to think about a market neutral strategy in an environment where interest rates are positive than it is when they're zero. And so I think, not to say you couldn't do it when they're zero, but I just think it's a lot harder to make the math work.
Tina made it very difficult to be on the short side when there was no alternative to equities. It was pretty much the only place you could go. But today, with rates over 5%, I think the last time I looked at the money market fund, it was about 5.25%, somewhere around then. I know you, when we were talking about fixed income, you mentioned securitized assets. What about other forms of private credit? It's been probably the hottest area in the market over the past few years.
Yeah, I mean, whenever there's an area of the market that is hot, I would say my first instinct is don't go there.
Right.
And private credit, I think there are a lot of reasons why private credit has done so well. But, and I do think the line is a little blurry in fixed income. And sometimes people call things private credit that are arguably in scope for some things that we might take a look at. But we do not have private credit strategies, and we do not intend to, because, we've really been focused on the areas of fixed income where we can identify dislocation. And so that's really what we feel like we can do in that core and short duration securitized strategies.
I only have you for a few minutes more. Let's jump to our favorite questions that we ask all of our guests, starting with what's been keeping you entertained these days? What are you watching or listening to?
So one show I've really enjoyed is The Bear. I haven't watched the third season yet, but...
we're about halfway through it, and it's really interesting.
Okay, good. I just think it's a great show. First of all, I'm from Chicago, and so I love the Chicago connection and constant visuals from, my favorite city. And then I just think their character development is unbelievable. So I've really enjoyed it.
Well, not just Bear and Sydney, but watching Richie develop from a caricature to a person has really, really been fascinating, culminating with the Forks episode, I think was season 2.
Yes.
Really was very amazing. Let's talk about your mentors who helped shape your career.
So I was very fortunate early on in my career to have a couple of kind of managers and leaders that really helped set the stage for a productive future career. Even at Bank of America, while I didn't end up staying there a tremendously long time, I had the most incredible first manager. And he really helped me see that there were lots of different areas in finance and investing to go into, and that he'd be supportive regardless. And I actually still keep in touch with him to this day. And then even at Driehaus, I had a great manager and the international portfolio manager at the time. And he really taught me about the kind of fundamental aspects that all investing holds, even more momentum-oriented investing. But he also was someone I've turned to in the past to ask deep career questions and kind of figure out where to go next.
So let's talk about books. And I have to mention your book, Why Moats Matter. Tell us a little bit about that. And then we'll jump into what you're reading currently.
So Why Moats Matter was really an encapsulation of thinking about competitive advantage and valuation in making investment decisions. And that does encapsulate Morningstar's investment philosophy. And certainly they commissioned the book or funded it, I would say. But it was a really great experience, too, because we were able to get a lot of the equity research team involved in writing it. So you'll see different chapters authored by multiple people, which I think was just a really great way to highlight some of the ways that you can apply competitive advantage thinking to different industries.
And tell us about what you're reading now and what are some of your favorite books.
So I just started Chip War. I don't know if you've read that, but...
I have it. It's in my queue. I haven't started it yet, but everybody seems to love it.
It's fascinating. And I think the thing that's so great about it is there's just so much around the topic of semiconductors and Silicon Valley and AI, and like really just understanding the fundamental underpinnings of how the industry got started and where the power lies and why TSMC is such a critically important company to the whole world. I think everyone should read it. And I also like it because it kind of falls into my favorite category of nonfiction written like a novel, or, sometimes that dabbles into a historical fiction. I don't know if you've read The Devil in the White City. That's a great book that's really about kind of Chicago during the World's Fair.
Larson?
Yeah, Eric Larson.
Yep.
Yeah.
I have a whole stack of his stuff. Everything he writes is so fascinating and dense and absolutely reads like a novel.
Yeah. I read something else, I can't remember the name of it, about the evolution of Edison and Tesla and Westinghouse right around the turn of the century that I think is another fascinating example of this category where, you're learning about real events and people, but in a way that feels like you're reading a novel. So I think there's a lot of great examples like that.
Really, really interesting. Our final two questions. What sort of advice would you give a recent college graduate interested in a career in either investment management or finance?
I'd say two things. First, seek experiences that will help you get the role that you think you want in the long term. And that one is really, I think, about not only getting experiences from your job and what you're doing day to day, but also, looking for opportunities to, let's say you're an equity analyst, but you want to move into a leadership role, you can try to volunteer in organizations or serve on the board of a nonprofit that can help develop leadership skills, even though your day-to-day job may be much more, investment oriented, for example. And another thing I always tell people who ask me this question is it's so important to put your hand up and make sure that your manager knows how you want your career to evolve, because people, I think, assume that they're going to get tapped for their next role. And I just don't think it generally works that way. I think if you can be proactive in saying, I would love to be an analyst on a different sector, or I'd love to be a portfolio manager someday, or whatever it is that you aspire to, then you can work with your manager on making sure you have kind of a long-term plan for developing the right skills, instead of just being disappointed when you don't get the job.
And our final question, what do you know about the world of investing today you wish you knew 30 or so years ago?
I would say that trends last longer than you think they possibly could. And so, you could see that right now in the small cap versus large cap performance that we talked about. You could certainly see it even at the end of the dot-com days. You could see it even in like the 2006, 2007 period, where so many investors felt like they knew housing was going to collapse, but nobody could actually hold on to their positions long enough, except for very few, to end up, making that a positive trade. So I just think there's so many examples where trends go on so much longer than you think. So you need to make sure to take that into consideration in your future careers.
Thank you, Heather, for being so generous with your time. We have been speaking with Heather Brilliant, CEO of Diamond Hill. If you enjoy this conversation, well, check out any of the 500 previous discussions we've had over the past 10 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you find your favorite podcasts. Check out my new podcast, At the Money. Short conversations with experts about topics that affect you and your money. Earning it, spending it, and most importantly, investing it. At the Money in the Masters in Business feed or wherever you find your favorite podcasts. I would be remiss if I did not thank the crack team that helps us put these conversations together each week. Steve Gonzalez is my audio engineer. Atika Valbron is my project manager. Anna Luke is my producer. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.